Hey traders, welcome to Charts and Coffee. Got myself a nice little, I don't even know what I made today. It's an espresso, but there's some odd amount of foam in here. Yeah, but anyways, we're ready to caffeinate and dominate and exercise some patience on a morning that we have Jerome. We've got the FOMC meeting, the statement, the press conference, and all the shenanigans that go along with it. And that's what we have coming up today at 2 p.m. Eastern. Ultimately, what we want to remember, what I'm going to think about as I deal with any hot zone, right? And our mastery folks know hot zones are volatility opportunities. Opportunities are not necessarily setups, but there are opportunities to find those wicks, those lows, those highs that are a little bit more extreme and therefore a little bit more likely to be exhaustive. And if they're exhaustive, we can take advantage of that because by the dip, if you want to think about it in terms of just regular words, forget the trading lingo. If we think about what, say, momentum trading is, buying through a higher high, buying a dip is simply exhaustion trading. And they're two sides of the same coin. Both those strategies are very, very good. Having both those strategies, a process for that is clearly a good way to be a well-rounded trader, but we're all going to favor one or the other, right? We typically are going to have a feel, a preference, right, for one or the other. And I prefer exhaustion trading. That's just the way it is. So it's really just a preference. However, we do have momentum setups. And I thought, since there is a lot of volatility right now and a lot of traders, I would say by far the vast majority of market participants are momentum traders. Nothing wrong with it, but if done improperly, momentum trading can be very risky. The cost of the option's higher when you're buying with the bullish momentum and you want to call. The cost of a put is higher when you're buying with that bearish momentum and you're wanting to get into a put. So the flip side of exhaustion versus momentum trading is, well, they all work really well in a trend. Now, I say that because, not that I want you to tune out, but we have a really cool video. Can I call one of my own videos cool? I don't know. But I posted a video yesterday using LRCX and SMCI, two kind of buzzworthy stocks, but it's less about the stocks and more about the pattern. And if you want to learn more about how you can use the very tools that I have used day in and day out for decades and say, Rog, I get that you do this exhaustion trading thing, but what about Momo? In that video, I walk you through exactly what Momo trading is. And it is really a spinoff in many ways of trend trading. It's just another way to engage the trend. So check that out. If you haven't already, check out that video. It's back at the Simpler Trading YouTube channel. Maybe you're there right now watching the show. You can check that out in the videos. If you're watching on X, thank you for watching. I love that we're posting Charts and Coffee on X. And if you're at my Simpler Trading YouTube channel at Raghee Horner, check out, and I'm going to start posting more videos there. So stay tuned. We have lots of plans for that. I know it's only Q1 of 2024, but there is a lot of content to come that will be unique to the Raghee Horner channel. In the meanwhile, let's talk about what's going on as we're preparing for the Federal Reserve, for Jerome, for Powell. And I'm looking at bonds right now. Bond traders are an interesting bunch. They're a smart bunch. One of my early mentors. I wouldn't call him a mentor per se, but he was probably the first real trader that I met. And I was very young. I was 17 and a half, 18 years old. And I used to work on a scuba diving boat. I was a dive master. That was one of my businesses. So I had this trading business that I was doing in my dorm, very clearly flunking out of college doing that. And then I also had on the weekends my dive master business. My captain and I had a boat, take people on trips. It was great. That said, there was one guy who said, I want a private on Wednesdays when I'm in town. Thinking, I got to skip class, which wasn't a big deal because I was missing class anyway. He was a bond trader and he had the Quotron. Y'all remember that? Looked like a Walkman, kind of a really big Walkman with this giant antenna. And he had a Quotron and he was a bond trader. Smart guy. And he started getting my interest in not just macro, but the impact of bonds and understanding. To me, trading was a very daily time frame, almost sort of an investing thing that I was doing. I really wasn't a super active trader at that point. And my appetite for active trading grew the more he would rent the boat out on a Wednesday, which happened maybe once or twice a quarter, and I'd get this education to and from the dive site from this trader, and I loved it. I loved it. And so I'm starting off with bonds as an homage to him. But what do bond traders, I remember one thing that he was always thinking about. They were thinking down the road, around the corner, and then up the hill. They're always thinking down the line. They're always thinking about what could be something that could change what central bank monetary policy could be. So remember, bonds aren't just about the now. They're actually very much in line with what the bond traders are expecting of one, monetary policy. So are yields going to be higher or lower? Let's just, reduce macro in the environment that we're in right now as to how much lower are rates going to be and when does that start? Right? Well, bond traders, if they're sending yields lower, which is to say, I know it's crazy, but when ZB moves higher, when TLT moves higher, that's a lower yield. And it also says, hey, Jerome, or whoever's in the big seat, the hot seat at the Federal Reserve, I wonder if they get a special chair. Do you think they get a special chair in the halls of justice at the Federal Reserve? I wonder if he gets a special chair or not. I imagine it might be a Games of Thrones looking chair. So what I want to know is, what do bonds say about whether or not that person in that magical chair is doing to the economy? And when bonds were heading lower, they're not only communicating rates aren't getting cut yet, they're also communicating by waiting, you're breaking the economy, central bank, you're breaking the economy, Federal Reserve, Jerome. And so if we think about it in those terms, bond movements make a lot of sense, and they sync up very nicely to what's happening. Notice we're not getting too far above the 200 or too far below. So that means we're in a holding pattern, right? There's nothing here telling us anything other than, let's talk about the real move in bonds. From October to basically the middle or end of December, bond yields went down as the bond market moved higher because, again, think about front running 6 months. Bonds were saying, hey, sometime in March, May, June, the Fed's going to cut rates. That's why, and you'll notice bonds like to front run it by about 6 months. So they've already priced that in. Now, what's next? And as long as bonds stay in this holding pattern, there's nothing to really have to worry about here. And as long as we continue to see, for the most part, the daily price movement ranges move sideways, the trend is sideways. It's not in a downtrend. It's just a little bit more bearish than we would think. And in fairness, we're not getting rate cuts this meeting, likely not next meeting. And even June is a coin toss. And there is your holding pattern in bonds. And then the next question is, well then, Rog, what about gold? Gold has a better trend. Gold is moving for reasons related to bonds. Gold moves mainly, I'm not going to say solely, but gold moves mainly on this response to something called real yields or real interest rates. You can pull up a chart on that. Anywhere. Just Google it. You can find a chart. And you'll notice that when real yields move lower, gold responds. When real yields are trending higher, gold responds. So keep an eye on that. And the reason bond and golds have a connection is because real yields are the nominal yield at the shorter end of the yield curve, a 1 to 3 year bond, minus the rate of inflation. And that's what we sit with in terms of understanding what it is that bonds are saying, gold is saying, and right now what bonds think the Federal Reserve is going to do. I'm not going to front run what it is I think they're going to do. I'm going to respond. The more we can start our day off remembering, and I don't know if you want to look at it as counterpunching. We let our opponent throw the punch. We'll either parry, we'll do whatever we're going to do, right? We're responding, counterpunching. Or, what is a batter at the plate other than a counterpuncher? The pitcher is the one in control. The pitcher knows what they're throwing. They're the ones setting the pace, right? The only job of the batter is to respond. So as long as we think about this from a responding perspective, not front running what we think they're going to do, what they might do, what's going to happen today, because by the way, I've been trading for a while. Seeing the future is not a skill or an indicator that exists. I wish. So we'll just remember to react and take a look. Gold is up, bonds are up, and the euro is up. If the euro is up, what does that tell us? The dollar is down. It's very, very early, but these are the things that I'll look at, these three things. Notice I did not say the S&P or the NASDAQ because unless you've not attended Charts and Coffee ever or haven't been here in a while, in which case, welcome back. Uh, Stock market's in an uptrend. We're seeing all-time highs. Markets are moving. Equities are moving, I should say. Stocks are moving, and they're moving when they're related to financials, industrials, communication, or heavily weighted in the NAS, the S&P. They're, for the most part, moving up. That is what we have. We have an uptrend. We have now for over 2 months. Please take advantage of it while it's here, right? It's like a great high school party. It starts when it starts, and at some point, one of the neighbors call the cops. We don't know when that's going to be, but enjoy the party while it's here. Don't worry about the end of the party. Don't worry about what's going to happen later. Just enjoy it for what it is right now. And that means we respond to what we have now, and we don't start thinking about what could happen in 3 or 6 months, because our indicators will do what? They'll adjust, right? Regardless of what set of indicators you have, they will adjust. And in that adjustment, we will adjust our strategy. So I hope that makes sense. And let's just sleep a little bit at night. Trading should not be stressful. It really shouldn't. It should be a little bit, it should push you. It might make you a little uncomfortable. It should test your patience. But as a general rule, trading should not make you anxious, because then at some point you're starting to trade too big, or you're trying to put the superpower of guessing what's going to happen on your plate. And it just doesn't have to be. So with that being said, Pat's kicking it off with copper. I love it, Pat. Copper is a symbol that I look at that would surround economic optimism. Obviously, stocks moving higher is not necessarily economic optimism. As it said, stocks are not the economy. That said, crude oil and copper in demand, moving higher, right, is good. It's good for obviously copper itself, XME. It's good for Freeport-McMoRan. It's good for companies that rely on demanding copper. But they also tell us that if crude oil is moving higher and copper is moving higher, and we're not seeing any kind of supply disruption or some sort of weird OPEC decision, OPEC's been pretty stable. This is just more demand. And copper and crude moving higher is a great confirmation of economic optimism. So buy the dip in copper. Yes, it's a relatively fresh trend. It's above the 200. Focus on the daily price movement ranges. And yeah, I would focus on it. And then where is the daily price movement range? That DPMR is a volatility tool. It is an interesting edge that we have uniquely here at Simpler that I have on my chart. And what it does is it's a whole new category. Traders, when we look at DPMRs, this is a different category of indicators, because it's not based solely on price, not really at all. It's not necessarily based on volume at 2 a.m. in the morning or 2 p.m. in the afternoon. It's based on the sort of cyclical nature, the day-to-day cyclical nature of how many points does a particular symbol move. And it's custom to each symbol. Copper moves differently than silver. Silver moves differently than gold. So we're going to do it at the DPMR. Pat, that's the plan. That's the plan. All right, David asks, and I love the idea of buying the dip, Pat. It's early. It's a fresh uptrend, which makes it a little vulnerable because it doesn't have that established uptrend psychology really backing up. Think about that as the energy, right? It doesn't have a lot of energy. It's fresh energy, but not a lot yet. David asks, can I please take a look at Wing for a long? It's in the wave, double green. So if we take a look at what's going on in Wing, yeah, there's not much not to like. But I'll tell you what, David, I don't trade Wing. And here's why. And again, I'm not here to say not to trade it. I just want to point out a few things that would keep me from trading. Number one, and this is the biggest reason, it's not in any way attached to the broader averages. Wing is cool. Look, I don't know, maybe when the stocks are heading higher, people like to go out for wings. Great, right? Who doesn't like, I prefer a grilled wing, but who doesn't like a wing? Celebrate another high in the equity markets with some wings. Flats only, no drums here. So if I am looking at Wing, yeah, it's a buy. It's not just a buy off the Darvis. It's got a mean reversion. The green, yellow, red is a 34 bar mean reversion, and it just works. And so it is definitely a trend but it's shaky as of late. So really what you're going to focus on instead of a pure Darvis play is preferably an oversold support level. So whether that be a slow stow, as I've taught for many, many years, or simply trusting the Darvis support, the mean reversion probability is better in a trend. The last time we did that, you can see, was back in the beginning of January. So I would look for something similar to that, but it doesn't move with the broader averages. That's number one. Number two, unless you're buying shares, David, this is a very illiquid. So if you're buying wing shares, forget what I'm about to say. But for those of you thinking, Rog, what about wing calls and puts? The call side is anemic. So beware of strikes that you might buy that might have less than 500 open interest. That's something we avoid in the mastery because low open interest typically means widespread difficulty getting in, difficulty getting out. And that's a risk issue, right? And heck, even if you're trying to take profit, it's an issue. So be careful of those illiquid strikes. All right, currency climb. Methinks a very hawkish Fed today. Yeah, we'll see what happens. Taiwan Semi, John. I like Taiwan Semi. It's the number 2 weighted stock in semiconductors. Obviously, we're going to need a post 230 volatility reaction. I want to be in after Jerome, not before, which is to say I want to buy it, but I want Jerome to maybe be a little hawkish or not as dovish. I don't think hawkish. Please remember, hawkish is meaning favoring higher rates. They're in a pause mode, so they're not really doves yet. They're not hawks anymore, right? But if they don't sound as dovish, that's going to send equities a little bit lower. And that's the kind of dip that I would like to buy in SMH or in TSM. And that's the way I would look at that. That's the way I would look at that stock. Is it my favorite? It's definitely one of the good ones, John. I think when we look at semis, let's do that together. I think when I look at this, my expectation is for higher highs in those specific stocks that are carrying SMH higher. As long as NVIDIA, Taiwan Semi, and even AMD, although it's a little wobbly right now, as long as those three are moving higher, they're heavily weighted. They're going to take the SMH with it. So definitely TSM, or you can take advantage of all the semis that you like that are strong, Qualcomm, NVIDIA, Taiwan Semi, and buy SMH, which SMH is a great alternative that we use in the Sector Secrets Mastery for NVIDIA because NVIDIA can be so darn pricey. All right, next up, can we take a look at the daily price movement range of AMD? There it is. AMD is less about the XLK, Anthony, and more about the SMH. So while it is heavily weighted in other places, this is going to be more tethered to SMH. So I definitely would keep an eye on that. Is it my favorite, Anthony? Remember, and I know you're a Sector Secrets Mastery member, if we are looking at that relative performance, if we're comparing things, while I am fine with a buy in AMD, it's a little bit more about the continuation of the uptrend after a pullback. And, we've seen this before. We've seen this back in February where candles go yellow, neutral, or blue if you're using the classic grab. That's not a problem because we're always going to presume continuation. That's what the probability is. It's not, let's not ever presume reversals. Pullbacks are not the same thing as reversals. Reversals are actually commentary on the trend, that the trend is broken and is now going from up to down or down to up. This is up to neutral. And I mean, just a little bit of neutral. So I wouldn't mind AMD, but it's not necessarily a top name, right? It's not a green name. It's not the one that I would say, hey, of all the names that are holding the trend, AMD is one of them, but definitely buyable. All right, let's wrap it up with Java, who asks, is the market exhausted since it's been up since November? No. That's all I have to say. Just no. And by the way, what does that mean? So let's say I said yes, Java. That's just asking how we hit a top. Nobody knows. No, the markets are not exhausted. Are they due for a pullback? I don't know. They will pull back. Are they going to break? Probably not. There's no reason to with the macroeconomic trends that we have with the election cycle, seasonal. That's also another help, not guarantee, but help. So no, my gosh, we've hit all-time highs. How can that be exhaustion? What do we say a lot of times? And this is straight from Henry. All-time highs are never bearish, right? All-time highs are never bearish. So that being said, thank you as always, gang, for being here for Charts and Coffee. I will see you tomorrow, same time, same station. Jerome hits the mic at 2:30, but the shenanigans begin at 2 p.m. Eastern with the FOMC statement, decision on rates, which is going to be a hold. That we can see from the target rate probabilities, and the Fed's not going to fight that on the day of, no. And we'll see what happens. All right, take advantage of those dips. They could come into tomorrow morning as well. So don't think it's going to be at 2:30 we buy a dip. Remember, wait for Jerome to shut up, then see how the close looks. And if it is a heavy close, we'll look into tomorrow. Be good to each other, gang. I'll talk with you soon.